I think longer term, silver's going to outperform gold simply because of the ratio. It's still over 60 to 1, and it comes out of the ground at 10 to 1. I mean, even if we don't get back to the historical number of 16 to 1, even if we get back to 30 to 1, it's still silver's going to basically double the performance of gold from here.
And I think the bottom line is this is why central banks are buying gold at a record pace. All of the cliches, gold is not someone else's liability, no counterparty risk, but they're true. And the game is changing because of deliveries. And a system that lacks trust, that wants to use bilateral trade to not use the dollar anymore, means they don't need to hold as many dollars, meaning they don't need to hold as many treasuries.
The current volatility in the gold and silver markets is best understood as a midpoint correction within a larger multi-year bull cycle. While short-term price action often triggers panic among retail investors, historical data from previous financial crises in 2008 and 2020 shows that metals frequently dip as investors hoard dollars to cover margin calls before staging a massive slingshot recovery. This down phase is a mechanical necessity of the current debt-based system, where decaying money units like the dollar, yen, and euro face accelerating debasement. As the Federal Reserve is forced to choose between systemic insolvency and massive currency injection, gold remains the ultimate inverse to a failing fiat ledger. Andy Schectman and Bill Holter are distinguished experts in monetary history and precious metals markets, emphasize that the shift toward physical settlement is a global response to a profound lack of institutional trust. They argue that the relentless drain of physical bullion from Western vaults, marked by delivery volumes 5 to 6 times higher than historical norms, is a canary in the coal mine for the dollar's status as a reserve asset. Their collaboration highlights why gold and silver are not just trades, but essential wealth preservation tools in an era of $39 trillion in national debt. Now, we present their clips from his interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I don't think that the dollar disappears immediately, Dunnigan, but I think it is beginning. The world is preparing for a system that is not all about the dollar. And we've been right, you and I, talking about this. We've focused on it being a fragmented system, right? A system that is not unipolar, but multi, where systems of local currencies, bilateral trade, settling in the one neutral reserve asset, gold. Why do you think central banks have been buying it hand over fist? Maybe they saw this coming long before we did, and we just I saw the gold being vacuumed up by new entities on COMEX that were given a new identification, the others. Remember, in 2020, the others? Who the hell are the others? Sovereign wealth funds. But now we've seen openly the central banks doing it. We're seeing it happen here, and I think that the fact that, countries are openly signing up to cross-border payment systems like the SIPs or the Embridge, and they're both operational, using local currencies, bilateral currencies, and settling the one neutral asset by which everything is measured in gold. There is no coincidence that this is happening. And Jim Sinclair was right. He was right. You stand for delivery, you win. But we probably don't have the power to do this. We certainly can add on to it now. We can be the icing on top of the cake. When central banks and people at this level are taking millions of ounces every month, and it's completely dismissed and ignored by the mainstream, missed altogether, I am as positive as I have ever been, ever, that gold is being rewoven into the system, because we are not trusted anymore. We are not trusted in any respect the way we used to be. We're not trusted. Our institutions aren't trusted. Our judicial system isn't trusted. Our government isn't trusted. Our markets aren't trusted. You look at 4 glitches on the LBMA, on the COMEX since Thanksgiving. 2 up, 2 down. Circuit breakers break, overheating, all a bunch of nonsense. You look at 2 glitches on the LME, the London Metals Exchange, which ironically is owned by the Chinese. But yet glitches that aren't glitches. They are we're supposed to believe it. Just like we're supposed to believe the night before Jeffrey Epstein passed away, his cellmate was moved out, the guards fell asleep, and the cameras didn't work. They're lying to us in our face openly. And I think the bottom line is this is why central banks are buying gold at a record pace. All of the cliches, gold is not someone else's liability, no counterparty risk, but they're true. And the game is changing because of deliveries. And a system that lacks trust, that wants to use bilateral trade to not use the dollar anymore, means they don't need to hold as many dollars, meaning they don't need to hold as many treasuries. This is where the problem starts to happen. We're massively in debt. The world doesn't want our treasuries anymore. Our fiscal irresponsibility and the lack of trust is getting to a point where if you hold in dollars and you don't see this, it'll be the biggest mistake you've ever made. You do not buy gold to get wealthy. You buy gold because it is wealth. And it has never been more obvious, if you're looking, that the people who make the rules are agreeing with that statement. And price is the greatest tool of misdirection. I've said that a million times, but it is betrayed by the deliveries. Period. End of story. Drop the mic. The deliveries that do not stop should be all you all need to see. Because at this level, at billions of dollars every month, these people do not screw around. And the fact that they are being covered in a cloak of journalistic nonsense, where nobody in the mainstream will talk about who's standing for delivery every month for 16, 17 straight months, and it is not stopping. And here we are, the first day of delivery. What did I say? First day of delivery, and we are at 1 million ounces of gold and 5 million, almost 6 million ounces of silver. And if this is the case, if I'm right, which in my gut, I know I am, maybe this is why the dollar's dropped to a 31-year low this month in terms of foreign reserve assets held by other central banks.
The global monetary system is shifting away from a unipolar, dollar-dominated model toward a fragmented, multipolar reality. This transition is driven by a profound erosion of trust in Western institutions, including judicial and governmental systems that no longer command international confidence. Central banks have responded by accumulating gold at a record pace, viewing it as the only neutral reserve asset with zero counterparty risk. This structural realignment is visible in the physical market, where participants are standing for delivery on Western exchanges at levels 5 to 6 times higher than historical norms. As major economies like India join non-SWIFT payment systems and settle trade imbalances in bullion, the paper trail used to manipulate prices is losing its efficacy. In a world of $39 trillion in debt, physical gold has returned as the ultimate anchor of value. Let's get back to the interview.
We're pretty close to a bottom. I think we probably have already made bottom a week ago, Sunday night, Monday morning. You got gold down to right at 4,000, and you had silver at $61. I think they ended the day up on that on Monday. But it looks like the bottoming process. It's happening. Whether we've hit absolute bottom or not, I don't know. But once this thing bottoms, I think you're seeing, because of the physical demand, I think you're going to see much higher prices, and I think new highs by the end of the year anyway. You can see that on the exchanges with the inventories getting hammered. You can see that where refiners can't keep up, and you can see it with central banks have been buying. Although I will say part of the reason you've seen softness in gold is there's been a systemic margin call, if you will, and what's been sold. Gold is one thing that's been sold to raise cash to meet margin calls. So yes, it's a hedge, but also it's a piggy bank. I don't think average normal people, that's not where the firepower is going to come from. You're going to see institutional money come in, and at some point there's going to be real fear out there, and fear is a much greater emotion than greed.
Certainly.
And also remember, on these paper exchanges, the leverage is to the downside. So if there's margin calls via fear, it'll be shorts being forced to cover it, in my opinion. I don't think it matters. I think longer term, silver's going to outperform gold simply because of the ratio. It's still over 60 to 1, and it comes out of the ground at 10 to 1. Even if we don't get back to the the historical number of 16-1. Even if we get back to 30-1, it's still silver's going to basically double the performance of gold from here. You have to pay attention to the industrial side. I mean, that's the story. Industry, the solar industry, medicinal uses, technological uses. There's so many more uses today than there was 10 years ago. And that's a big part of the offtake from the inventories has been for end uses all over the world. Just for the control, governments are going to want central bank digital currencies. There's still going to be fiat currencies. They're not going to tell you that. They're going to tell you, oh, we have a brand new wonderful currency. Same boss, the same new boss as the old boss. And I don't think those are going to, I think those will fail largely. And at some point in time, and the BRICS are a perfect example of wanting to create a currency that has backing, commodity backing, gold backing, silver, oil, et cetera, et cetera. They want a real currency that will allow for real and fair or true settlement. The way it is right now, there's no settlement because, the U.S. imports something. What do? They just print more money. Europe imports something, they print more money. That's what these governments do. But I don't think that, I don't think the next central bank digital currencies, I don't think they will survive. I think they'll be questioned. Maybe they only last 6 months or a year. I don't know. You have to understand that financial markets, including stocks, are grossly over-levered. And when that leveraging unwinds, you're going to see much lower prices. I mean, even in my lifetime, you've seen a Dow to gold ratio at 1-to-1. Back in 1980, you had the Dow at 800 and you had gold at 800. I mean, you very well could see the Dow collapse to 25,000 and gold go up to 25,000. There you go. You're back to the 1-to-1 ratio.
Yeah. Would you expect, Bill, let's say a year or two from now, a stock market to be higher from here or lower?
In fiat terms, very well could be higher. But in terms of gold, if you measure it versus gold, I think the stock market will be much, much lower. In other words, it'll take less gold to buy the same stock market unit.
The global financial landscape is characterized by a profound disconnect between the perceived stability of paper markets and the reality of a fracturing debt-based infrastructure. While mainstream outlets focus on nominal gains, the persistent drain of physical bullion from Western vaults serves as a definitive signal that the world is preparing for a new monetary paradigm. This structural realignment is not merely a technical correction, but a fundamental restoration of gold as the primary measurement stick for global value in a world of $39 trillion in debt. As central banks and shifting trade blocs like BRICS accelerate their pivot toward physical settlement, the traditional paper tail that has long manipulated prices is losing its ability to mask systemic insolvency. The upcoming months will likely test the limits of institutional trust as the dollar reaches multi-decade lows in terms of foreign reserve assets held by other nations. This environment of fear and loathing creates a unique opportunity for those recognizing that gold is not just a trade, but wealth itself with zero counterparty risk. Once the current liquidity washout is complete, the path toward a multipolar system settled in neutral assets will likely become the defining trend of this decade. Securing physical positions now offers a strategic exit from a system reaching its mathematical limit. Share your thoughts in the comments section below. If you found this market analysis valuable, please support the channel by liking this video and subscribing to more exclusive precious metals content. Don't forget to hit the notification bell to stay updated. Thanks for watching.